Hello everyone, and welcome to the Finance and Risk Corner. Today we explore together fixed income securities, a highly technical and one of the most important topics in the CFA curriculum. You cannot afford not to understand fixed income securities. First, because fixed income as an asset class is one of the most important parts of any investment or retirement portfolio. Second, governments of most countries issue sovereign debt to raise funds. This public debt, often measured by debt to GDP, has profound implications on financial and monetary stability, investor confidence in this country, and also intergenerational equity. Think of a government that borrows excessively today by issuing sovereign debt, and how the burden of repaying principal and interest on that debt falls on the shoulders of future generations. For many reasons, you cannot afford not to understand fixed income securities. So let's first start by defining a bond. A bond is a liability. When an entity issues a bond, it is actually borrowing money. And bondholders, i.e. investors who buy those bonds, are lending money to the issuing entity. You can think of a bond as a loan that can be traded. So when a company, financial institution, or government issues a bond, it's borrowing money from bondholders who bought that bond. If bondholders at some point decide to sell that bond in the market, they can do so. Of course, the liquidity of the bond becoming an important factor because many bonds are thinly traded and are quite illiquid. But a bond can be seen as a loan that can be traded, bought and sold in the open market. So what are the defining elements of a bond? First, the issuer, of course. You want to know the entity that is issuing money because this is the entity to which you're lending money. And contrast lending money to a AAA rated government with lending money to a CC rated company in an emerging country, for example. Obviously, credit risk is not the same. The safer the issuer, the lower the credit risk, and by extension, the lower the required compensation, the required rate of return that is demanded by investors to accept to buy those bonds. So knowing who the issuer is of course of fundamental importance. Maturity. This is the date when the issuer has to repay back the loan, repay back the borrowed funds. Maturity is very important because it allows you as investors to manage your cash flows. By knowing when the money will be returned, but also when and how much interest will be repaid on the loan, you can manage your cash inflows and make sure that your inflows can actually meet all potential outflows. Also, the longer the maturity, the higher the credit risk and the interest rate risk or the sensitivity of that bond to changes in interest rates. So first, credit risk. The probability that an issuer experiences financial difficulties and sees its creditworthiness deteriorate is by definition higher over a period of 10 years versus a period of 1 month. If you lend money to an entity for 1 month only versus lending money to that same entity for 10 years, the probability that that entity experiences difficulties and is unable to repay you back is of course higher over a 10-year horizon. Also, the maturity will influence how sensitive the bond is to changes in interest rates. We will have the occasion in future videos to have much deeper dives into sensitivity to interest rate risk and duration, but today it is important to intuitively understand that when interest rates go up, the price of bonds go down. The price and the value of any loan actually goes down. And to understand this intuitively, think about the following example. Think about lending money for only 1 month at a 3% rate of return, and then the next day interest rates go up from 3 to 4. Of course, you're sad. You could have earned 4% by lending this amount, and you're only stuck with 3%. This is an opportunity cost, but the problem is not that important because it's only a matter of 1 month before the loaned funds return back, and you can now lend them at the now higher rate. So the opportunity cost is only for a month. Now contrast this with lending money for 10 years at a 5% interest rate, and then suddenly interest rates go up to 6%. There is a huge opportunity loss because this 1% you will not earn it for 10 years. Alternatively, you have locked yourself in an investment in a loan that will earn you less money for 10 full years. definitely the price of the bond will reflect that fact, will reflect the higher sensitivity of longer term or longer maturity bonds to changes in interest rates. So maturity is very important. The currency in which the bond is denominated is also important for two reasons. One, currency risk. If you buy a bond denominated in a currency that is not yours, not your domestic currency, then you could lose money just because the foreign currency actually depreciated. If the currency loses 15 or 20% of its value, even if the bond performs well, you as an investor might end up having a net loss, which is once again the result of the currency that the bond is denominated in deteriorating. Second, it is the currency that the bond is denominated in that dictates to which interest rate you're actually sensitive. So if you buy a bond denominated in Japanese yen, then this bond is sensitive to changes in interest rates on yen, not on euros, not on dollars. Of course, you might speak of interlinkages and how rates can influence each other, but still you are directly sensitive to changes in interest rates on the yen. Par value. The fourth defining element is par value. That's the amount of money that is paid back at maturity, irrespective of how much you paid to acquire the bond. Because as we will see later, you can buy the bond at a price that is lower than par or higher than par. Irrespective of that fact, at maturity, the issuer always pays back par value. The coupon rate is the interest rate that is periodically paid on the bond. It's also of paramount importance that you remember that the coupon is always a percentage of par value. So irrespective how much you paid to acquire the bond, if the coupon is 5%, it's always 5% of par value. Now, with that in mind, let's move on to basic bond valuation. So we've seen in a previous video together how to value an instrument today, you need to discount all future cash flows at the required rate of return. The most important thing to understand as of now is that the required rate of return on a bond is called its yield to maturity. The yield to maturity of the bond is how much investors require to accept to invest in that bond. Investors require 5% to accept to buy that bond, or by extension, lend money to the issuing entity. Now look at the bond's elements. We have a 5-year annual pay bond, so the coupon is paid annually, with a par value of $1,000 and a coupon rate of 5%. The coupon rate is not what you as a bondholder actually end up making annually in terms of return. The coupon rate is simply the interest rate that the company, the issuer, decides to pay on the bond. Sometimes what the issuer decides to pay on the bond matches with how much investors require to accept to buy that bond. And sometimes there is a mismatch. We'll see how this mismatch translates later on in the next slides. So let's value the bond. Consider this simple timeline. We want to value the bond today. We know that the bond matures in 5 years, so at the ends of year 1, 2, 3, 4, and 5, we have a coupon of $50. Also, at the end of the 5th year, which is the maturity of the bond, we have par value of $1,000 that is paid back. This is why we have 4 cash flows of $50 each, and then the last cash flow is $1,050. So we need to discount those future cash flows at the yield to maturity to value the bond today. You can do it the long way, of course, by discounting each cash flow at the yield to maturity raised to the power the year corresponding to the year where the cash flow occurs. So the third coupon is discounted at 1 plus yield to maturity raised to the power of 3. By doing that, you get the value of the bond equal to $1,000. Of course, there is a faster way to do that with your financial calculator. So you will use the time value of money application within your financial calculator. First, never forget to clear the history of this time value of money application, because you don't want irrelevant previous information to be carried forward to this exercise where they are, as I said, completely irrelevant and you would have a wrong answer. So first, always, when you touch your calculator, clear time value of money. Next, you start to input the elements of the bond and ask the calculator to compute the value. So N is 5, because that's the maturity of the bond. The payment is $50. That's 5% of 1,000, which is par value. The future value is always par value. That's how much you'll earn back 5 years from now. Interest rate, or the yield to maturity, is 5. You don't need to write 5%. The calculator knows that the yield is expressed in percentage. So you only need to input 5. And then you ask the calculator to compute the present value. Of course, we would obtain the same result if we use the calculator or if we use the manual discounting of cash flows. Now, one note before we move forward. The calculator would give you an answer of negative 1,000. Typically, you would be told to ignore the sign, which you obviously need to do. It's 1,000, not negative 1,000, of course. But to understand why the calculator uses this negative sign, and to also understand why sometimes the calculator produces an error message, all you need to do is to put yourself from the perspective of the bondholder, the investor. So what the calculator is simply telling you is the following. You need to pay, hence the negative, you need to pay $1,000 today to acquire the bond so that you become entitled, so that you now have the right to receive, hence the positive, payment of 50 and future value of 1,000. This explains why the signs here are opposite. You need to pay $1,000, hence the negative, to be entitled to receive the next 5 payments of $50 and the future value of $1,000 at maturity. Of course, some candidates would write payment equal to negative 50 and future value equal to negative 1,000, then the calculator would show a present value that is a positive 1,000, opposite signs. It is still correct, guys, but you are now taking the perspective of the issuer. So the issuer will issue the bond and collect $1,000 when they issue the bond, right? When the issuer issues the bond, someone will buy that bond and $1,000 will flow. It's a positive cash flow, right, to the issuer. Now, against this $1,000 that flows in, the issuer has to pay $50 of coupons and pay back the future value of 1,000. So both are correct. The calculator is just understanding that you could either take the perspective of the bondholder or you could take the perspective of the issuer. In all cases, payment and future value will have the opposite sign when compared to present value. Good. Now, this is a simple framework that will be super helpful, not only for CFA Level 1, but also for Levels 2 and 3, believe me. And of course, even if you're not a CFA candidate, it's very important that you have a good understanding of what's on this slide. So we know by now that the yield to maturity is the required rate of return. That's how much investors require to accept to invest in a bond. Now, we can always think of the yield to maturity on any bond as a combination of 2 elements, the risk-free rate and an additional spread. Now, let's focus first on the risk-free rate. This is the rate of return that investors require even when they invest in zero credit risk bonds. Imagine buying a US Treasury bill issued, of course, by the US government in USD. It virtually has no credit risk. So even when you have no credit risk, you're still requiring a given rate of return, which we call the risk-free rate. Now, it makes perfect sense that if you buy a bond that has zero credit risk, you require some money. Now, if you're buying a bond that is risky, which means that the issuer could actually default and not pay you back your money, you want to require more. And this extra compensation is called the credit spread. In reality, it's compensating you for additional credit spread and additional liquidity spread compared to a risk-free instrument. The yield to maturity on any bond can be decomposed this way, and it would really be super helpful to understand it from the start. Now, of course, if you buy a risk-free bond, then the yield of that bond is the risk-free rate. But anytime you buy a bond that is not risk-free, i.e. issued by a company, a bank, a government that is not rated very high in its own currency, then you will require, as investors, you will require an extra compensation, or else you're being irrational. So imagine you require 2% to accept to buy a risk-free paper, then definitely if you're buying a riskier paper, you need to require more. And this more, this extra compensation, is captured by the spread. Now, why is this framework very important? Because it can clearly show you guys that the yield to maturity on any bond can change for two different reasons. The yield to maturity on a given bond could change because the risk-free rate is changing. The general level of interest rates in the market is actually going up, for example, which will drive the yield to maturity of all bonds up. But there is another fundamentally extremely different reason why a yield to maturity on a bond could go up. It could be that the risk-free rate is unchanged, but it is the extra compensation, what we call spread, that is actually going up. And why would it go up for a given bond? If investors suddenly perceive that bond to be riskier, then they will no longer accept to buy that bond unless they are compensated more, because they now perceive the bond to be riskier. So the spread on that bond will go up, the yield to maturity will go up. Again, this is a fundamental, simple framework, but that will allow you to recognize that the yield to maturity on any bond can change because of two very different reasons. It could be the general level of interest rates, or it could be the specific credit risk of the issuer who is now perceived to be riskier or safer. And this is something that relates to the issuer itself. We call it specific or idiosyncratic. Now is the time to think about what happened on the earlier slide, where the coupon rate matched the yield to maturity, and we discovered that the price of the bond was equal to par value. Again, this is a video that contains fundamental elements which, honestly, if you understand very early on, you're doing yourself a big favor, because a lot of more complex things that will come later in the curriculum, levels 1 to 3, will be really simplified because of this. So I want you now to focus on the coupon. The coupon is the rate, the interest rate that the issuer decides to pay on its bonds. This is a decision that completely belongs to the issuer. The issuer can decide to pay 5%, 10%, or even 0%, which would make it a zero coupon bond. Of course, the issuer is pressured to offer a coupon that is in line with the liquidity needs of the market participants. However, the issuer has its own liquidity concerns, so the higher the coupon rate that the issuer pays, the more cash outflows the issuer has to meet every time it pays the annual coupon. But that said, you must know that the coupon rate is decided by the issuer, and the issuer has the discretion, subject of course to market realities, the discretion in deciding that coupon rate. Now, whatever the issuer decided, we have the other leg, the other side of the story, the market or investors. And what the market wants is reflected in the yield to maturity. Remember, this is the required rate of return that investors demand to accept to buy that bond. So think about it, it's like buying and selling. If I'm selling something for $10, it doesn't mean that a market will magically appear. I need to find someone who's willing to buy it for $10 for a trade to actually occur. Same goes here. The coupon rate is what the company is offering. The YTM, the yield to maturity, is what investors want. Now, the company is offering 5%, please remember, always on par, because the coupon is always paid on par value. So we have on one side the company that is the issuer that is offering 5% annually on par. Now we have the market or investors who require 5% on their money to accept to buy that bond. The question is, how much should the investors invest, knowing that they want 5% on their money and knowing that the issuer is paying 5% on par? And the answer is obvious. Investors need to invest an amount equal to par value. Again, for investors to make 5% on their investment, knowing that the issuer is paying 5% of par, then investors need to invest an amount equal to par. When the company pays 5% of par, and it happens that investors also invested par, then they will be making 5%, which is the required yield to maturity. This explains why when the coupon rate is equal to the yield to maturity, the price is equal to par. Of course, mathematically it's obvious, and we can demonstrate it like we did here. When the coupon is equal to the yield, the price of the bond turns out to be equal to par. But my preferred way is not only the mathematical way, it's to understand the mechanics of how the fixed income market works. On one side, you have an entity that pays 5% of par. On the other side, you have someone who wants to lend money to that entity, but wants 5% on the invested amount. The invested amount needs to be equal to par, since the company is paying 5% on par for investors to actually achieve 5% on their money. Now, what happens when the yield to maturity, i.e. the rate required by investors, doesn't match the coupon rate? Once again, this framework will help us a lot. The YTM on the bond in our example is 5%. Imagine that the risk-free rate is 2%. So this means that investors are requiring an extra compensation, which we call the spread, of 3%. The 5% is equal to 2 plus 3. Now you guys know, and I've explained in the previous slide, that the yield to maturity on the bond could actually change either because the general level of interest rates is changing, or because the specific risk of the entity issuing the bond is changing, so investors are now demanding more or less spread. So imagine one of those two reasons happened. So either the risk-free rate went up by 1%, or the company just issued its annual report. It's very bad. The company lost market shares, it lost 2 of the largest clients, it is subject to lawsuits, etc., and the prospects are not good. And investors are more concerned now than they were 1 day ago regarding the capacity of the company to repay back its debt. So they no longer require a 3% spread, they require now 4% spread. This will push the yield on the bond from 5% up to 6%. What happens concretely? We now have the same bond that was just issued, paying a coupon of 5%, but the yield to maturity is now 6%. First, mathematically. We value the bond by discounting the future cash flows, same future cash flows as in the earlier example, but now at the higher yield. Of course, mathematically, this cannot but translate into a lower price for the bond. Same numerator, denominator is increasing. Of course, the overall value of the fraction would actually fall. So mathematically, it's really simple and obvious that when the yield to maturity goes up, the price goes down. You can confirm on your financial calculator by just changing the yield to maturity to 6 and then computing the price of the bond to see that the bond price is 957.88. But what interests me more is that you understand that beyond the mathematical evidence that if the discount rate goes up, the price will go down, this is what's actually happening in the market. So as we did earlier, we have a company paying 5% on par, and that's the golden key. The company always pays 5% on par. Now, investors would never accept any longer to invest in that bond if they only earn a 5% YTM. They now require 6% because they believe the company is riskier. But what investors want is 6% on their investment, which means on the price that they would pay to acquire the bond. Now think about it. What's the only way of making 6% out of an instrument that pays 5% of par? The only way to make more is to actually acquire that instrument for less than par. And this is what actually explains, beyond the mathematical reality, that when the discount rate goes up, the price goes down. What actually practically explains what's going on is the company pays 5% of 1,000. Investors would never accept to earn only 5%. They want 6% on the amount L that they would invest to buy that bond. The only way they can make 6% is if they buy the bond for less than $1,000. And here how it goes. And again, this explains why the price of the bond is lower than par value. And that's a reality you need to know. Whenever the yield to maturity is higher than the coupon, yes, the bond will trade at a discount, meaning that the price of the bond will be lower than the par value. Now look at what's happening in reality to consolidate your understanding of things. Now imagine you buy the bond for 957.88. So someone bought it at 1,000 and then the yield suddenly went up and this person is now looking to sell that bond. You would never buy the bond for 1,000 because if you buy it for 1,000, you would earn a yield to maturity of 5%. You want to earn 6 because you perceive the company now to be riskier. So you are only willing to buy the bond for 957.88. Now imagine you do that. I want to show you how the company is paying 5, but you're actually making 6 on your initial investment. First, I want to view it as two sources of extra returns that explain how you're actually earning 6. So first, guys, remember that the company is paying 5% on $1,000, which means $50. But you, the new investor, did not invest $1,000. You invested 957.88, but you're still earning a coupon of 5% on par on the 1,000. So 5% of 1,000 is higher by definition than 5% on 957. If you divide the $50 by 957, you're actually earning more than 5%. So this is the first source of extra return that explains how you're actually earning 6 while the company is paying 5. Now there's a second source. Remember that at maturity, they always pay you back par value. So 5 years from now, you will receive $1,000. But again, you never invested $1,000. You only loaned out, you only invested 957. So that's an extra gain because at maturity, they will pay you back 1,000, but you only invested 957. Together, those two sources of extra return, i.e. 1, the fact that you earn a coupon of 5% of 1,000 while you only invested 957, 2, you will be paid back at maturity 1,000 while you only invested 957. Those two sources will actually explain why at the end of the day you would have earned 6% per annum and not 5. Changing the example now to see the opposite scenario. So imagine now the company is perceived to be much less risky, right? So the company now gained new market share, signed a contract where the positive cash flow is huge. So everyone is now less nervous regarding the capacity of the company to pay back its dues. So people no longer require a spread of 3%, they now require a spread of only 2%. And the yield to maturity on the bond will fall from 5% to 4%. First, mathematically, again, the obvious concept that if the denominator goes down, the numerator remaining equal, of course, the total value will go up. So when the yield went down to 4%, the price of the bond shoots up to 1,044.52. you can confirm on your financial calculator by simply changing the yield to 4% and computing the present value of the bond, which will give you also, of course, 1044.52. Now that we're familiar with our way of thinking and beyond the obvious mathematical reality of a higher value when you discount at a lower rate, let's understand or confirm our understanding of how things practically work. One more time, we have a company paying 5%, but on 1,000. We know that. Investors now accept 4% on their investment to accept to buy this bond. They require 4% to accept to buy this bond. What's the only way of making 4% on an investment that pays 5% of 1,000? The only way is to buy that bond for a price that is higher than the 1,000. And this explains why when the yield to maturity is below the coupon, the price will trade at a premium. The bond will trade at a premium, which means that the bond price in the market is actually higher than par value. There are people out there, guys, there are investors out there willing to lend money to that company for only a 4% profitability, for only a 4% yield to maturity. This will automatically translate into a bond price that goes up to 1044.52. Now, as we did earlier, let's convince ourselves why we are buying or how we are buying a paper paying 5%, but we end up earning only 4%. Because here, there are two sources of losses that actually makes you earn 4% at the end of the day. It works in the exact opposite way compared to what I did earlier. First, guys, you're paid 5% on $1,000, but you invested more than $1,000. So you're actually collecting less than 5%. That's the first source of loss. Second source of loss is at maturity, the company will pay you back $1,000. One more time, you invested more. You invested $1,044. So there is a $44.52 that will never be returned to you. Those two sources of loss combine and explain why at the end of the day, you earn 4% per annum on that bond and not 5%. Please remember that the coupon is absolutely not a measure of profitability. You can issue a zero coupon bond, but if it's traded at 800, there is a yield, there is a profitability. You're buying something for 800 and 5 years from now, they will pay you 1,000. So the 200 are actually your profitability and the yield to maturity is quite high. The coupon is not a measure of profitability, it's just a measure of liquidity. How much cash will flow out of the issuer and into your pockets as an investor. Your measure of profitability, yet not a perfect one, is the yield to maturity. On the exam, in real life, please be ready to understand that when the coupon equals the yield, the bond will trade at par. When the coupon, like in this example, is lower than the yield, the bond will trade at a discount. The only way to make 6% out of an investment that pays 5% of par is to acquire the bond for less than par, so that the 5% represents more than 5%. And of course, when the coupon is higher than the yield, the bond will trade at a premium. I'm showing you here on this slide how the price of the bond changed when the yield changed. So we started from an initial yield to maturity of 5% and the bond was issued and traded at par. Here we're seeing together what happened when the yield went up from 5 to 6. The bond fell to 957.88. When the yield went down from 5 to 4, the bond price went up to 1044.52. There are two very important messages that you need to carry with you forward. Of course, again, in later videos, we will dissect this reality and understand duration, convexity. It will be a lot of fun to do that together. But for now, there are two things you need to understand. First, this is a non-linear relationship. It's a non-linear relationship in the sense that when the yield went up by 1%, the bond lost $42. But when the yield went down by 1%, the bond gained $44.52. We don't have a linear, when I say linear relationship, it would have been represented by a straight line, which would show perfect symmetry. If the yield goes up by 1%, I would have lost exactly how much I would have gained when the yield goes down by 1%. The reality is non-linear. The bond gained more when interest rates went down compared to what the bond lost when interest rates went up. And this is a non-linear relationship. This also explains why we speak of convexity when we talk about a bond. Again, much more on this in a later video. Also, please notice the inverse relationship, which by now should be something that is completely basic for you guys. It's an inverse relationship because when the yield goes up, the price goes down. And when the yield goes down, the price goes up. We have seen this both mathematically, when the denominator changes, how it impacts the price of the bond, but we also tackled it from a very practical perspective, and how the only way to make more than the coupon on a bond that pays the coupon is actually to buy the bond for less than par value. There's an inverse non-linear relationship between price and yield. Excellent. Moving forward, we know by now that the yield to maturity is a measure of profitability for the bond and not the actual coupon payment. We know that. Now, do we really achieve the YTM? When we buy the bond and the bond has a yield of 5%, do we really achieve this 5% per annum? Also remember, please, that the investor locks in the yield that corresponds to the price that the investor paid for that bond, i.e., if this bond was just issued and I bought it, I'm locking in a yield of 5%, unless, of course, there's a credit event or something else. Now, if the yield goes up to 6 and somebody else buys the bond at this point in time, the yield that they have locked in is 6, while the yield that I have locked in is still 5. So every investor will lock in a yield that corresponds to the yield that existed when the investor purchased that bond. But all that said, do we really achieve the promised yield to maturity? The discussion here will center around 3 conditions. There are 3 conditions which, if they prevail, yes, you would end up achieving an annual profit rate that is equal to the promised yield to maturity. Every time I'm saying promised yield to maturity, it is the locked-in yield when you bought the bond. Those 3 conditions must exist for you to actually achieve the promised yield to maturity. 1, you must hold the bond to maturity. If you sell the bond prior to maturity, you might not achieve the yield to maturity if the yield actually changed before you sold the bond. And of course, we will see practical examples. So the first condition to actually achieve the yield to maturity is to hold the bond to maturity or sell the bond prior to maturity, but provided that the yield to maturity did not change. The second condition is you must actually collect all the promised cash flows. If the issuer ends up defaulting and you're not even paid your coupons, of course, it goes without saying that not only you will not achieve the yield to maturity, you will suffer a huge loss. When governments defaults, some bonds will trade at 15% of their par value post-default. So if you owned that bond, you actually lost 85% of your money. That's not only a yield that is lower than 5%, that's a much negative yield. That's a deeply negative yield. So you must collect all promised cash flows. The issuer must not default. You must earn the coupons and par value. So, first two conditions, which are typically much easier to achieve. As long as you held the bond to maturity and you actually earned the promised coupons and par value, you're good to go so far. Now, the third condition is the most problematic one. To achieve the promised yield to maturity, you need to reinvest every interim cash flow at the promised yield to maturity. I refer you back, guys, to the previous video on IRR that I hope that you watched. If not, I invite you to do so. Because one of the problems of IRR is that it assumes that all interim cash flows are precisely reinvested at the IRR. What we mean here is that if you buy a bond with a yield to maturity of 5%, like in our previous example, when it pays you the first coupon, you must be able to reinvest that first coupon for the remaining 4 years until the bond matures at a 5% rate. Only if you succeed in reinvesting every single cash flow at the yield to maturity will you end up achieving the promised yield per annum. To be practical, let's go back to this slide. To really achieve the yield to maturity of 5%, guys, this is what should happen in reality. At the end of year 1, when you collect the first $50 of coupon, you must find a way to reinvest it for the remaining 4 years at 5%. And of course, you must do so in an instrument that has a similar risk to the bond that you actually purchased. Or else it's not the same because you're taking more risk. Continuing the idea, the second coupon that you earn at the end of year 2, you must succeed in reinvesting it for the remaining 3 years at 5%. Every single cash flow that you earn must be reinvested at the yield to maturity. You might ask yourselves, why is it such a problem? It is a problem in real life, especially that yield curves are very rarely flat. So what is a yield curve? A yield curve will actually show you, for a given issuer, how much yield you can earn as a function of time. Simple example. If you invest in a 1-year bond, you can earn, let's say, 2%. If you invest in a 3-year bond, you can earn 4%. And if you invest in a 5-year bond, you can earn, let's say, 5%. Now look at the bond that is subject to, that we're actually working with, right? It's a 5-year bond, and this is why its yield is 5%. Now I want you just to think about that. Think about this cash flow. The $50 that occurs at the end of year 4. You must reinvest it for 1 year, because that's the remaining maturity of the bond, at 5%. Where will you be able to find a 1-year investment that actually pays you as much money as a 5-year investment? I want to remind you again that your yield to maturity is 5% because you're buying a 5-year bond. The yield curve being rarely flat, it's typically upward sloping. Typically, I'm saying, of course, sometimes it inverts, but the yield curve is upward sloping, meaning that it's going to be more and more challenging as you collect those coupons that are closer to maturity. It's going to be very challenging to be able to reinvest them for such a short remaining time at a rate that is as high as the 5-year rate. And this is why practically it is very, very hard to do it, especially when the yield curve is steep and when the bond has a very high yield. If the bond has a yield of 9%, then you guys must be able to reinvest every earned coupon at 9%. Even the one that comes in year 3 and 4, which will only be reinvested for 1 year or 2 years, how will you be able to find a way to reinvest them for 1 or 2 years only and still earn 9%? So practically, this is the condition that makes it really hard, especially when the yield curve is steep. Think with me one last time. If the yield curve was absolutely flat, then this condition is very easy. When the yield curve is flat, it means that a 1-year, 3-year, or 5-year bond, they have the same yield. So the rate that you could earn is the same regardless of maturity. Then it's very easy when I earn the before last coupon, even though I need to invest it for only 1 year, I can still earn the same rate because 1-year rates are equal to 5-year rates. But this is typically almost never the case. So this third condition is really the one that is problematic. Hence this icon here, which is showing a slippery road, right? Or a path. So it is the condition that is the problematic one. It is the one that is very hard to satisfy in real life, which is the ability to reinvest every coupon at the promised yield to maturity. In the next slide, and you guys need to be capable of replicating all this reasoning and all those calculations for your exams, of course, and for fixed income investors watching here, you need to be able to do it for your own sake, of course. In this slide, we will demonstrate that yes, an investor who holds the bond to maturity, earns all the cash flows, and succeeds in reinvesting all the coupons at the promised yield, yes, this investor will achieve the yield to maturity per annum. But anytime we deviate from those conditions, then there's a risk of achieving less, or if you're lucky, achieving more. Go back to our example. Consider a 5-year annual pay bond with a par value of 1,000, a coupon rate of 5, and a yield to maturity of 5. The bond was just issued. All right, guys. Whenever you buy a bond that is denominated in your own currency, which means that there is no currency risk, no potential currency gains or losses, there are 3 avenues, 3 sources of returns. And I want you to be comfortable with all of them. They are of paramount importance for the exam and in real life, if you're a fixed income investor or you plan on one day becoming one. You can make money out of a bond that is denominated in your own currency, so we move away currency gains or losses, from 3 sources. First, the coupon income. This is a 5-year bond. If you buy it and you hold it for 5 years, you will get exactly 5 payments of 50. So 5 years later, you are richer by $250. Simple and easy. The second source of return is reinvestment income. And remember, this is the problematic one because we don't know, we cannot control reinvestment income. Every time we earn a coupon, we need to reinvest it, but we don't know what the interest rates prevailing at that point will be. Reinvestment income is the fact that every coupon that you earn, you actually reinvest. Now imagine in this case, someone actually succeeding in reinvesting each interim cash flow at 5%. Remember that our task is to prove that if they manage to do so, yes, they will achieve 5% per annum. On the exam, be familiar with this trick that will allow you to solve for reinvestment income. To solve for reinvestment income, recognize first that you have 5 coupon payments, equal value of 50, uninterrupted for 5 years. This, by the way, is the definition of an annuity. And look here how it's extremely interesting and important to be able to link between topics. This is a quantitative method topics, annuities, but your good understanding of annuities will actually allow you to have a good understanding of reinvestment income. So you have 5 payments of $50 flowing in the future. This is an annuity. Then all I need to do, guys, is take my financial calculator and calculate the future value of that annuity, assuming I can earn a 5% interest rate. So you take your calculator and you do the following. N is 5. The payment is 50. That's the annuity. We have 5 payments of 50 occurring. Present value is 0, obviously, because beyond those 5 payments, I'm not getting anything today. So PV is 0. If you have clear time value of money, you could leave PV empty. But if you did not clear time value of money and you leave PV empty, the calculator might take the last PV that you entered from a previous exercise and everything will be wrong. So for extra safety, always make sure you clear TVM and you input PV equals 0. So in case you forgot to clear TVM, you're telling the calculator PV is 0. Now what's the interest rate that we are assuming? We are assuming that we are able to earn 5. Now compute future value. The calculator will show you 276.28. Stop for a second and think about it. What is the 276.28? It is the 5 coupon payment of 250 plus all the reinvestment income that you were able to make over time on those coupons. The 276.2815 embeds at the same time the 5 payments of 250, here you go, here they are, plus the interest that could be made on those. So by doing 276.2815 minus 250, you have isolated the reinvestment income. And this is your second source of return, reinvestment income. One more time, the 276.28 is the future value, i.e. with reinvestment income, of the 5 payments of $50 coupons. It includes both. So all you need to do is to remove the $250 to isolate the reinvestment income of 26.2815. The last and third remaining source of return is any capital gain or loss. Do we have any in this example? No. You bought the bond for 1,000. You waited until maturity, so you naturally were paid 1,000. 0 capital gain. In this example, there are no capital gains or losses. Now let's calculate together, guys, the actual profitability per annum on that bond, and let's check whether it is equal to the promised yield to maturity. Were we able to lock in that rate? Were we able to achieve the promised yield to maturity given that the 3 conditions prevailed? We know before the fact that yes, we were able. We're just demonstrating it. Now, how do we demonstrate it? You have the long way. What is the initial value that you invested? $1,000. What is your total level of wealth 5 years from now? Let's count them together. 5 years from now, they pay me back the $1,000 par value. I would have collected 250 of coupons and 26.18 of reinvestment income. Also, 0 capital gains or losses. So 5 years from now, I would be the proud owner of $1,276.2815. Knowing that I started with 1,000 and I ended up with 1,276.2815 5 years from now, what is my average annual rate of return? That's the geometric mean. The formula would simply be future value divided by beginning value, or final value divided by beginning value, raised to the power 1 over n, because this rate of return was achieved over 5 years. By raising it to the power 1 over 5, I'm actually calculating the 5-year average. And of course, minus 1 to remove the original capital, and the actual achieved annual rate of return is 5%. And notice how it exactly matches the promised yield to maturity. Guess why? Because 3 conditions prevailed. You held the bond to maturity, you earned all the promised cash flows, i.e. the coupon and the par, and you succeeded in reinvesting every interim cash flow at the 5% rate. This would result in an annual rate of return that matches the promised yield. Now, the short way would be to use the financial calculator. Of course, here this is future value. You simply tell your calculator that you started with a PV of 1000. Notice the negative because you invested 1000. You ended with an FV of 1276.2815. Notice the positive because that belongs to you, that comes back to you. 0 payments in between. You started with this, you ended with that. Over a period of 5 years, and you ask the calculator to compute the yield. Not a surprise, the yield is 5%. What happens if one of the conditions is actually not respected? Any one of those 3 conditions could not prevail, and it would mean that the actual achieved annual rate of return would be different from the promised yield. Let's do that. Again, the 5-year annual pay bond with a par value of $1,000, a coupon rate of 5, and a YTM of 5. You bought the bond. It was just issued and you bought it. Now, immediately after you bought the bond, the yield went up to 6. Still, you decided to hold it to maturity. Think about it with me, guys. When the yield goes up to 6, the bond falls to 957. So you bought the bond for 1,000 and it suddenly fell to 957.88. You have a capital loss, but wait, think. This capital loss exists if you sell the bond immediately. If you hold the bond to maturity, at maturity, remember, they always pay you back par value. So no capital loss would actually remain if you hold the bond to maturity. And that's a golden key here. One more time. When the yield went up from 5 to 6 after you purchased the bond price falls from 1K to 957.88. It is a capital loss. You lose money. You lose a lot of money if you sell the bond now. But if you hold the bond to maturity, you guys will receive the par value at maturity, which means that you will receive not 957, but 1,000. So the capital loss would not materialize if you hold the bond to maturity. Remember the condition. Hold the bond to maturity. So we will hold the bond to maturity. Let's see what would happen here. As we did earlier, you will hold the bond for 5 years. So the first source of income is that you will collect $250 of coupons, exactly like in the earlier example. Now, unlike the earlier example, rates have gone up. So you will now reinvest those coupons no longer at a 5% rate, but at a 6% rate. So you take your financial calculator, it is still an annuity, a 5-year annuity. It is still a 5-year annuity of $50, but now the investment rate is 6%. The calculator will compute the future value of that annuity, which I remind you contains at the same time the 250 coupons that were earned over time plus the reinvestment income. So this 281, by the way, notice how the 281 is higher than 276, which is natural since you are investing at a higher rate of 6% versus 5. Remove the 250 coupons to isolate the reinvestment income. Don't fall into the trap of thinking that there are capital losses. Because you held the bond to maturity, you know that you will earn back par. Since you purchased the bond for 1,000 and you earned back 1,000 at maturity, no capital gains or losses. Let's see how much we achieved per annum. Like we did earlier, we started our investment journey by investing $1,000 to acquire the bond. How wealthy are we 5 years from now? What do we have in our bank account? We have the $1,000 that the issuer paid us back. We have the $250 in coupons. We have 31.85 of reinvestment income, and we have 0 capital gains or losses. We are the proud owners of $1,281.8546. let's calculate the average annual rate of return achieved. As we did earlier, final value divided by beginning value would give me 1 plus the rate of return. Of course, math is a language. So I need to tell the formula, by the way, I did not grow 1,000 to 1,281 in 1 year. I did that over 5 years. So by raising to the power of 1 over 5, we are calculating the average annual return over that 5-year period. And of course, we remove the one which is the original capital to isolate the annual profit. 5.091. We have achieved more than the promised yield of 5%. And by the way, one more time, it's extremely important. Do not compare the 5.091 with the 6. The 6 is irrelevant to you. I told you earlier, when you buy the bond, the yield on the bond was 5. This is the yield that you lock in. The 6 is irrelevant to you. It's for someone else if he buys or she buys the bond when it yields 6%. So look how we achieved more than the promised yield. And why is that so? Because not only we respected the third condition, we outperformed it. Not only were we able to reinvest every interim cash flow at 5%, we were actually able to reinvest the cash flow at 6%. 6% rate of return. And this is quite important. This is why we actually achieved a rate of return that is higher than the promised yield to maturity. 5.091 versus 5%. Because we respected the three conditions and more. We reinvested the interim cash flows at a rate that is higher than 5%. Of course, if we sell the bond prior to maturity, remember the first condition being you must hold the bond to maturity. Now, what if we sell the bond prior to maturity? What would happen then? What if the yield goes up to 6% and you sell the bond after 2 years? This framework can save your life because it's very easy to apply. You bought the bond for 1,000. The yield went up to 6. You held the bond only for 2 years. Let's start the analysis. The first source of return is the coupon income that you earned. But please be careful here. You only held the bond for 2 years, so you only collected 2 coupon payments for a total of $100. Now, you reinvested those coupons at a 6% rate because the yield went up. So this is a bit complicating the idea, but still the same logic. We take the financial calculator. We tell our calculator that we have an annuity of 2 payments of 50 with the investment rate of 6. Please compute FV. The calculator shows you 103. By now, you know that the 103 embeds at the same time the 2 coupons that were earned, i.e. $100, plus reinvestment income. This means that we can easily isolate reinvestment income, which is 3. Now, do we have a capital gain or loss, and how much? Yes, we do. Because when the yield to maturity went up from 5 to 6, the bond went down to 957. Of course, you did not sell it immediately. You sold it 2 years later, but not at maturity, so you don't get par. The bond would have converged a bit towards par, but you'd still be far from par. In the next slides, I will show you how the bond convergence work. A loss still exists, guys, because you sold the bond for less than 1,000. Now, the trick on the exam is to know how much did I sell the bond for. Unprepared candidates would start looking at the selling price and think they are not giving me any selling price. How do I know? Of course, you can know, guys. The bond is a 5-year bond. You held it for 2 years. So when you sold it 2 years later, this bond was now a 3-year bond. Think about it. 2 years from now, what was a 5-year bond is now a 3-year bond. So now you know that when you sold the bond had 3 years remaining to maturity. value it like you would have valued any 3-year bond, i.e., take your calculator and say the following things. The remaining maturity for the bond is 3. The face value is still 1,000. 3 years from now, you do get 1,000, which is par. The yield is now 6 because the yield went up. Compute PV. And the calculator would give you 973.27. Let me go back a bit to this timeline because everything is easier on that timeline. So you bought the bond, guys, and 2 years later, just after you earned the second coupon, you decide to sell. Think about it. What are we selling? We are selling a 3-year bond. The instrument that you're selling now is a 3-year bond, which has 3 remaining coupons of 50 and the par value of 1,000. And it is yielding a 6% rate of return. Excellent. So if you take your financial calculator, you can actually value the bond here by telling your calculator, listen, I have a 3-year bond with a coupon of 50, a par of 1,000, a yield of 6. Tell me what it should be worth here, which is the point in time where you sold the bond. So when the calculator answers you 973.27, you know that this is the price you are selling the bond at. You bought the bond for 1,000, you sold it for 973.27, the difference is a capital loss. Now let us calculate the average annual actual rate of return that we would have earned and see how it compares to the promised 5. We can before doing the calculations, we can clearly know that obviously the actual annual achieved return is much less than 5 because we have a capital loss. Let's do what we did earlier. We started with an initial investment of 1,000. At the end of the 5-year horizon, we have, okay, so actually the 1,000 minus 26.73 is a way of saying we sold the bond for 973.27. I might have said at the end of a 5-year horizon, excuse me, it's at the end of the 2-year horizon because we sold the bond 2 years later. So 1,000 minus 26.73, you could also have written this as 973, which is the selling price of the bond that enters your account, your bank account, when you sell the bond. What do we also have? We have the $100 that we earned in coupons and the $3 that we earned in reinvestment income. Total, $1,076. We started with 1,000. We grew this amount to 1,076.27 over a 2-year horizon. So by doing this, you get an average annual achieved rate of 3.74%. Much, much lower than the promised 5%. Why? Because of the capital losses, because of the fact that you sold the bond prior to maturity at a loss. You disrespected this condition. You sold the bond prior to maturity at a loss. So when this happens, you are actually achieving less than the promised yield to maturity. All right? So I think this should be clear by now. One last example is, what if the yield falls to 3% and you sell after 2 years? So here you will also break the first condition by not holding the bond to maturity, but now you are breaking it at your own terms in favorable times. So you bought the bond, the same story. The yield goes down to 3%, but you sell it 2 years later. Let's apply the simple framework. The first source of return is the 2 coupons that you earned over the 2-year horizon, total 100. Like we did earlier, we will ask the calculator to compute the future value of a 2-year annuity, $50 payment, yielding 3%, 101.5. Notice how it is lower than the 103 because in the previous example, the reinvestment rate was 6%. In this example, the reinvestment rate is only 3 because after you bought the bond, interest rates fell to 3%. Now, you can isolate the reinvestment income, which is 1.5, by removing 100 from 101.5. Now, do we have capital gains or losses? Yes. When the yield went down to 3%, the price of the bond goes up. If we held the bond to maturity, then we would have collected par, no capital gains would have existed or remained. Since we sold the bond prior to its maturity, then we sold it for a gain. All we need to do is to recognize that on this timeline, 1, 2, 3, 4, and 5, this is where we sold the bond. What did we sell at that point in time? We actually sold a 3-year bond. Because what was a 5-year bond is now a 3-year bond. So what we actually sold here is a 3-year bond. Let's value it. We need to tell the calculator we have a 3-year bond, coupon of 50, nothing changed, fair value of 50, the yield is 3, compute present value. And the calculator will give you 1056.57. You have $56 of capital gains. One last time, we started with an initial investment of 1,000. 2 years later, we are the proud owners of 1056.57 when we sold our bond. You could have written them in one number instead of 1,000 plus the capital gain. And then $100 in coupons, and then $1.5 of reinvestment income, for a total of 1158.07. Now you started with $1,000, which you grew to 1,158.07 over a horizon of 2 years, so raised to the power 1/2, remove the original capital. The bond achieved an actual return of 7.613 per annum, per year, over the 2-year horizon. Much, much more than the promised 5%. Why? Because you did not respect the 3 conditions, but it turned out favorably here because you sold the bond with capital gains. Be ready on the exam to calculate the annual return achieved, to isolate reinvestment income, and to be able to understand everything that was on that slide. So I spoke about the bond converging to par as maturity approaches. Think about it this way. This is the maturity of the bond, and the bond was issued at par. This is par, guys. Right? Now think about it. If interest rates go up, the bond will drop immediately. We know that. From 1,000 to 957.88. If you sell it, you lose. But if you wait, knowing that at maturity, so let's say here is maturity. This is the dimension of time, and this is maturity. We know that at maturity, you must be paid back par. So you will see that over time, the bond will slowly but surely converge to par. If you sell your bonds 2 years later, this is the price at which you will sell it. You still have a capital loss, but one that is smaller than if you have sold it immediately after the rates went up. Now, if you wait even more and you sell it here, yes, there will still be a capital loss that exists, but one that is even lower. Why? Because as time passes, as the bond gets closer and closer to its maturity, the price will converge to par value. And this is also something to understand that will make all the previous slides easier to grasp. Now we can prove it with numbers, of course. If you take a bond that was just issued with 5 years remaining to maturity and you apply a yield of 6, this is basically our bond, the bond we've been dealing with in our example, the price is 957.88. Now don't change the yield, assume the yield remained 6 forever, but revalue the bond every year. 1 year later, i.e. 1 year since issuance, the remaining maturity would be 4. Value the bond now and the price will be 965. 4 years after issuance, the bond will have only 1 year remaining to maturity. Tell your calculator now that n is 1 and compute the present value. You'd see that it gets higher and higher until it gets exactly equal to 0 when there are 0 years remaining to maturity. You are at the maturity point. So you can obviously see here in numbers what I showed you here on this graph. You can see the price moving from 957.88 to 965, then 973, then 81, then 990, and then of course par at maturity. Of course, the opposite works if the bond is trading at a premium. So one more time, this is time, this is maturity, this is par. The bond was just issued at par and the yield went down. The bond price will shoot up. If you sell it, congratulations, you can lock in this capital loss. But if you hold it to maturity, it will slowly but surely converge to par. If you sell it 2 years later, you still have gains, but gains that are smaller than the actual gains that existed when the yield immediately went down. This is translated here in this table. When the yield is 4% for our same bond and 5 years remaining to maturity, the bond trades at 1044. This is here, let's say. Now, as time passes, and even if the yield remains at 4%, it's okay. As time passes, as long as there are no credit events, no default by the issuer, then you will see that the price will fall actually over time, right? Until it reaches exactly 1000 at par. And this again helps you in understanding why when interest rates fell or went up in a previous example, because you held the bond to maturity, you had no capital losses. Because at maturity, you always get par value. Excellent. We will conclude today's video by discussing spot rates and the existence of spot rates. So by now, you are experts in understanding how yield to maturities are interpreted. They are the required rate of return. They are the closest measure to real profitability that we have. And if we manage in reinvesting every coupon at the promised yield, the yield becomes the actual measure of profitability, 100% correct and accurate. But something should be bothering you. There should be something that is not really making sense, because you now know that a yield to maturity compensates investors for the level of risk they take. The riskier the issuer, the higher the YTM. We know that. And the safer the issuer, the lower the YTM. Something should be bothering you, because even for the same issuer, a cash flow occurring in 1 year does not carry the same risk as the cash flow occurring 4 years from now. Think about it. Even if it's the same issuer, the $50 that this issuer will pay me in 1 year is safer. Because the probability of things going south, of things becoming bad for that issuer from now till 1 year is much smaller than the probability that things could deteriorate from today till 4 years in the future. So obviously, a YTM is a compensation for risk, but there is something broken here. Things are breaking down here, because a 1 year cash flow has a risk that is lower than a 2 year cash flow, which itself has a risk that is lower than a 5 year cash flow, but still we are using the same yield to discount each cash flow. This is problematic in a way when we conduct analysis, because we're not really seeing anything related to the yield curve, the shape of the yield curve. And what do I mean by that? I'm treating all cash flows coming from the same issuer, but at different moments in time, I'm treating them as having the same risk. You might ask yourself or ask me, why is this a problem? It's a problem because the different levels of risks between the 1, 2nd, 3rd, 4th, etc. cash flows are not clear, they're not apparent, they're not appearing anywhere if you use the same rate, which is the yield to maturity. By the way, we do use the yield to maturity, and it's the correct thing to do. But for analysis purposes, we use spot rates, and for more complicated analysis. So it is problematic, because if this issuer has a yield curve that goes like this, then the 1-year cash flow is much safer than the 5-year cash flow. I cannot see how much safer it is, or how do they compare to each other when I use the same number for them all. I cannot see it. If I'm interested for any reason to see what's the difference between the risk of that issuer over 1 year or 2 years or 4 years, I cannot see it. A yield to maturity is completely blind when it comes to the shape of the yield curve. How much riskier is the 4th cash flow relative to the 3rd? How much riskier is the 5th cash flow relative to the 1st? I can't see it, because I'm using the same YTM for all. It is still a correct thing to do, because you would have guessed by now the YTM is a form of an average risk, which is used for all of them because it averages the risk across them all, across the 5 cash flows. Of course, taking into account that the weight on the 5th period is much higher than the weights on all previous periods. More on this in a second. But this is what should be bothering you with a yield to maturity. When I look at the slides, it's a testament of how much work we've done together over those hour and 20 minutes, right? So much writing. So why do spot rates exist? Because the yield to maturity is a single rate that is discounting all cash flows, no matter when they occur, irrespective of their different levels of risk. So it is completely blind as to the shape of the yield curve and how much more riskier are cash flows in relation to each other. So this is our problem. Let's state it. The problem is that the YTM uses the same discount rate even though cash flows have a different level of risk. We know that. Also, we cannot see the shape of the yield curve, hence the icon here. With time, you would notice that I sometimes try to choose the icons in a way to match the idea. Not always, it doesn't always work, but we'll get used to it. So this yield to maturity is blind again when it comes to the shape of the yield curve. Solution: spot rates. Let's come up, and in future videos together, we will learn how to calculate spot rates ourselves without relying on anyone giving them to us. We can bootstrap them from the current prices of bonds. But now you need to intuitively understand that spot rates are special rates. Spot rates are rates that are only accurate to discount a cash flow that occurs in one specific maturity. For example, instead of having one yield to maturity, you will have a 1-year spot rate, a 2-year spot rate, a 3-year spot rate, a 4-year spot rate, and a 5-year spot rate. Each spot rates will only discount the cash flow that occurs in the period for which this spot rate is relevant. So the 2-year coupon must only be discounted at the 2-year spot rate. Obviously, you're now seeing a form of a yield curve, of a spot rate curve, we call it. We will leave the complex stuff about spot rates for another video. But so far, look how the problem with yield to maturity was actually corrected. You can now see those 5 spot rates for an issuer who has a yield to maturity of 5.319. I'm going to tell you something from the start. If you use the 5.319 in the financial calculator and you value the bond, the price will be 986.30. At no point in time did I imply that yield to maturities are incorrect. Mathematically, they are perfectly correct. You come up with the right answer when you value a bond. For analysis purposes, however, they obscure, right? They do not show you how different cash flows have different levels of risks and the shape of the yield curve, which you'll see later on and in levels 2 and 3 is of paramount importance. So whether you value the bond using the single YTM of 5.319 or you discount every cash flow at the appropriate spot rate, every cash flow is discounted at the appropriate spot rate. The 2-year cash flow highlighted in green is discounted at the 2-year spot. The 3-year cash flow highlighted in yellow is discounted at the 3-year spot rate, of course to the power 3 because for 3 years. Now if you value the bond by discounting every cash flow at the appropriate spot rate, you will also get 986.30. So we have no problem in using the yield to maturity. We will get a mathematically correct answer. We will also get that answer if we use each spot rate. The difference is in later on, of course, the analysis, the quality and the depth of the analysis that we can do by seeing and clearly identifying the different levels of risks of cash flows coming from the same issuer, one more time, but at different points in time in the future. This is how we can, and this is why we use spot rates. It is enough intuitively for now to understand that this is why we use them, to circumvent the problems that we have on yield to maturity. One last nice thing, because we like to view math as a language, we like to link things. Look at the yield to maturity and think about it. It works if you value the bond using that rate for everyone, or you use for each cash flow the corresponding rate. But remember that this rate, if used for everyone, for all cash flows, it works. So it is a weighted average of all rates, right? This is what an average is. You either use for each cash flow the corresponding rate, or there exists one rate which if you use it for everybody, it also works. This one rate is the yield to maturity. And why does it work? Because it's a complex average, it's a weighted average of all the spot rates weighted by the size of the cash flow. And you should like it here when I show you how the yield to maturity is closer to, the closest rate to the yield to maturity is the 5-year spot. Because the 5-year spot is the one that carries the largest weight when we do the average of those. And why does it carry the largest weight? Because the 5-year spot discounts $1,050, whereas the 4th spot rate only discounts 50. So the bulk of the cash flows is discounted at the 5-year spot. So if you wanted to use an average rate, which is the YTM, it's by definition mathematically the closest to the 5-year spot. The weight on the 5-year spot is actually the largest. Thank you for watching this video today. I hope that you are finding our videos useful, beneficial. I hope they are helping you either study for your exams or simply understand financial topics the right way, in what I would like to say the right way, hopefully. Of course, if there is anything that you're not understanding or anything that is not explained in the way that you would have loved it to be explained, please always feel free to drop comments, to ask follow-up questions. And again, your suggestions when it comes to the topics that we should cover in the future are most welcome. I'd be very, very happy to have your suggestions. If there are any topics that you are finding especially difficult or particularly complex, please never hesitate to drop us a comment and let us know how we can help you. So again, thank you and see you soon in the next video.